Hello everyone, this is Jay, and in a previous video I've asked the subscribers for a few suggestions on growth stocks, maybe some that I can take a look at and probably add one into this portfolio. And one of my longtime subscribers who has been subscribed to the channel since pretty much the beginning of the channel suggested a few stocks in the comment section. So I wanted to do some research on two of them actually, and then towards the end of the video I'm gonna compare the both of them in the Seeking Alpha tab, and I want to see the total return between the both of them and see which one performs better and which one might be maybe on past performance the better option for me, right? So let's go right into the updates tab, which is right here, and it is Randy who commented, and the comment says this: a couple of growth ideas, SPGI, they are a duopoly on credit rating agencies, the other being Moody's. Ticker on that one is MCO. Buffett actually owns Moody's. I like SPGI because they own the names S&P and Dow Jones. So anyone who uses the S&P name has to pay them a licensing fee. Another growth idea is BRKB, Berkshire. I bought in 180s a few years ago. Randy means $180 when he started buying those shares, which is nice. It was the easiest double that I have had in my life. Please do your own due diligence. So let's take a look in the stock analysis tab at SPGI, which is right here. Name of the company, S&P Global. Market cap for this company is $136 billion. Earnings per share 8.23. PE ratio 52.19. Forward PE 30.39, which shows some signs on the valuation, but of course no one can predict the future, so we can only see where it goes from here. That dividend, this company does pay a dividend, which is $3.64 per share per year. The dividend yield 0.85%, so it's less than a 1% dividend yield, but we want to take a look at the dividend growth also. The 52-week range, it was at $321.15 as a 52-week low, and then the high is $461.16. The analysts are calling this a buy right now. The ex-dividend is on February 26, 2024. So if you want to add any shares, it will definitely be nice to grab them before the ex-dividend date, so you can get that nice dividend right there that they give. So let's take a look. Performance in the past 5 days, it is down 4.93%. In the last year, they are up 15.95%. And then in the last 5 years, this company is up in price appreciation only 121%. Which if you bought 5 years ago, any shares that you bought 5 years ago, today you will be up 121%. That's definitely really nice. You would have doubled your money pretty much. Now let's take a look at the financials right here. Let's take a look at the revenue, this chart looks really, really good. In 2014, they had a revenue of $5 billion. 2017, $6 billion. 2020, $7.4 billion. In 2023, they finished the year with $12.4 billion. So that revenue just continues to grow and grow and grow. Which is showing very, very good signs. And then the shares outstanding, as you can see, they were buying back shares, which is very good for the shareholder. And in 2021, they finished with 240 million shares, but then they started issuing shares again in 2022, and they went back up to 316. And then it looks like in 2023, they issue even more shares at 318 million shares. So I'm sure they're going to start buying back some shares, but that's not a very good sign to continue to issue more shares unless they had a very good plan with those shares. But this company looks really good so far. The earnings per share, as you can see, it has been very good and very consistent at 7.80 in 2018, 9.71 in 2020, 10.25 in 2022, and then 8.25 in 2023. And then let's take a look at the free cash flow. And as you can see right here, it is growing, that free cash flow, which is very good sign right there. Only in 2015 they had only 88, pretty much $88 million, I guess. that's pretty much what I'm trying to read. And then they went above $1 billion right there in 2016. Then $2.6 billion in 2019, then 3.5 in 2021, then 3.5 in 2023. So they have been growing their free cash flow. It has been growing pretty good. Let's take a look at the debt very quickly. And the total debt, as you can see, they have been growing their debt also. Oh wow, that's a lot of debt. But they have some good free cash flow also. So in 2015 they had $3.6 billion in debt. Then in 2019 it grew to $4.5 billion in debt. And then in 2022 they acquired a lot more debt into 11.5. So just gotta take a look to see why did they acquire all this debt and why did they issue so many shares in the past 2 years. That will be some good questions to ask, and if you know the answer, please leave it in the comment section. I would definitely appreciate it. Maybe one of the other subscribers is looking into this company, so any information that you have, it will definitely be appreciated. That dividend yield, as I've said before, 0.85%, $3.64 per share per year. Then that payout ratio, only 44%. So they're only using 44% of their free cash flow to pay the dividend. Dividend growth in the last year, only 4.64%. So they did not grow their dividends by that much. But we got to take a look later on, comparing it with Moody's, right? So let's take a look at Moody's right now. And this one, it is, ticker symbol was MCO. Name of the company, Moody's Corporation. Market cap for this company, $73 billion. So it's a smaller company than S&P Global, right? If you take a look right here, S&P Global is 136 billion. Moody's is only $73 billion, but it's still a huge company. The earnings per share, it is at 8.22. PE ratio, 48.79. Forward PE, 37.02, so it's showing signs of undervaluation in the future. Then dividend, $3.08 per share per year. If you pick up any shares right now, your dividend will be at 0.77%. The 52-week range is $278, 52-week low, $407, 52-week high, and the analysts are calling this a buy right now also. The ex-dividend date, it passed already on November 22. Their earnings date is going to be in February 5th, 13. So we still have a couple more days before they show their earnings. And they do not have their earnings right here for 2023. So they're waiting on that. Maybe we can do another review in a couple of weeks. Once they announce earnings, we can then definitely compare it to S&P. But let's take a look at the revenue for this company. As you can see right here, it is growing the revenue, which is a good sign. In 2014, they had $3.3 billion in revenue. 2018, $4.4 billion in revenue. 2021, 6.2, and then it went down in 2022 to 5.4. So I would like to know how it is in 2023 for sure. So let's take a look in a couple of more weeks. The shares outstanding, as you can see, this is very, very good sign. They have not been issuing shares. They pretty much ended the year in 2022 with 183 million shares, which is very good. As you can see right here in the chart, they're just lowering their shares and they're buying back more and more shares. They have not issued any shares, but I don't have the 2023 information here yet. So we should maybe take a look in a couple of days. The earnings per share, it has been pretty good. 4.69 in 2014, 6.84 in 2018. Then they went all the way up to 11.88 in 2021. So it looks like they had a very good year in 2021. Then 7.47 in 2022. Now let's take a look at the free cash flow. And the free cash flow it has also been pretty steady also with some nice growth. And as you can see right in 2014, they had $944 million in free cash flow. Then 2016, 1.1 billion. In 2019, 1.6. 2020, 2 billion. And then it started going down after 2020. In 2021 to 1.8. In 2022, 1.1 again. So definitely would like to see the 2023 numbers. So let's take a look at the total debt, and the total debt is definitely growing also at $3.3 billion in 2015, $5.6 billion in 2018, and $7.9 billion in 2021, and 7.86. So they paid some off in 2022, but that debt, it is growing. The dividends right now, as I've said before, 0.77%. If you pick up any shares right now, $3.08 per share per year. That payout ratio is only 37%. That payout ratio, which it looks very, very nice. The dividend growth in the last year, 10%. So more than double in dividend growth than SPGI. So now let's take a look at the Seeking Alpha tab right here, and I already have them right here to compare them. And as you can see, in the last year total return only for SPGI, you would have gotten, with dividends reinvested, pretty much a 17% total return in the positive for SPGI if you bought it a year ago, but then you would have gotten a 29.15% return. So this looks very, very good for Moody's right there in total return. Then in the last 3 years, if you bought SPGI and Moody's about 3 years ago, you would have gotten to buy today in total return with dividends reinvested at 29.9% with SPGI and a 47.76% return with Moody's, ticker symbol MCO. Now let's take a look in the 5 years. Let's open it up right here. And as you can see, Moody's continues to stay on top at 130% SPGI and 157% total return with Moody's right there. And then let's go down a little bit so we can see the 10-year total return. Now this is where everything starts changing, and it is at that 10-year total return, which is for SPGI 498% total return in the 10-year return with dividends reinvested, and the 459% with Moody's right there. As you can see, let's take a look at the dividends stats right here. And that dividend, the 3-year growth CAGR for SPGI, it is 10.34%, and Moody's, it is 11.20%. Then the 5-year growth CAGR, it is 12.47% for SPGI, and then 11.84% for Moody's right there. So SPGI looks like it beats Moody's in the long run. And as you can see right here, consecutive years of dividend growth, 50 years for SPGI. So 50 years dividend king status for SPGI. Nothing gets more safer than that, right? From what it looks like in numbers. And then 14 years in dividend growth for Moody's right there. Please leave me in the comment section which one is your pick. Which one do you think will be a stock that you will add to your portfolio, or do you have it in your portfolio and it has been performing very well? I really would like to know. Please leave me your opinion in the comment section. Don't forget to hit the like button, subscribe, and I don't know, maybe one day I'll add one of these into my growth portfolio, which it will definitely look really, really nice. I like both of them. I honestly, I do have to do a little bit more research as to why did they get some, they get into debt like that by that much, and why did SPGI issue a lot more shares. So those are some questions that I have. But honestly, anything else, I saw some very, very good numbers in my opinion. I did like both companies. And then I'm also going to do a review on BRKB, the Berkshire Hathaway stock right there. Maybe another one that I could probably add into this portfolio. I don't know yet. I do want to grow these positions right here. I do want to buy some more Google. I'm going to try to deposit a little bit of money. I have like an extra $10, $15. I might deposit and I might put it into Google actually. So I could put a little bit more money into Google this week. All right, everyone. Please don't forget to hit the like button, subscribe, leave me your opinion. Which one do you choose? I might put a poll tomorrow or later on today on this one and see what your votes are. Once we get a good amount of views, I really would like to know your opinion. All right, everyone. I'll definitely hope you enjoyed it, and I'll see you on the next one. Thank you. Disclaimer, I am not a financial advisor, and this is for entertainment purposes only. Please do your due diligence and research before investing in the stock market. Thank you.